All right, gang. So welcome to the Options Greeks course. And in this class, we're going to cover the Greeks. What are the Greeks? So the Greeks, if you guys can remember the Black-Scholes math model that we talked about in the previous class, well, the Greeks are the individual variables that make up that, that whole math formula. It's basically individual parameters or individual measurements that actually measure sensitivities that's happening to the underlying stock that's impacting the price of your options. That's basically what the Greeks are. Now, there's 5 different Greeks, okay? You have delta, you have gamma, you have theta, and then you have vega. And then you also have rho, okay? Now, the hesitation on rho is because we barely use rho, and so you barely have to really think about rho. We're going to cover rho here as well, but for the main part, there's 4 that we mainly focus on. It's going to be delta, gamma, theta, and vega, all right? So basically, what delta is that delta is the sensitivity that it basically lets you know how your options premium is going to move based off of every $1 move in the underlying stock. So if Apple here moves up $1, the delta is going to let you know how much your options premium is going to make money. And if it moves down, $1, it's going to let you know how much money you're going to lose every dollar that this underlying stock loses. So delta is a price sensitive variable. It's letting you know that it's price sensitive. So every dollar's move, your options are going to make money or lose money. So remember that we're trading options and not stocks. So the options premium have multiple variables that's going to help us to make money. So it's not just price alone. So price is one variable. The second Greek is going to be gamma, and gamma is the accelerator of delta. It's going to let you know how fast delta is going to actually move. So it's like the little brother. I like to think about it as the little brother of delta. Okay. So you have gamma that's actually letting you know how delta is going to accelerate. Okay. So the value of delta, how it's going to move along the way. So and basically gamma, as the options gets closer to expiration, the gamma actually it increases. And so it adds to the value of your delta basically. And then the next Greek that we cover is theta. Theta is a time-sensitive variable, okay? So this is separate from price. So price, we just covered the 2 Greeks that covers price movements. The next variable is time. So every day that goes by, that means that we get closer to expiration on your stock, basically, the position that you're trading. And every day that time goes by, this could eat away the premium of your options. Now, again, that really depends on your strategy, because theta is going to be based off of how you entered that trade. Did you enter in as a buyer or did you enter in as a seller? And so as a buyer, theta is the enemy of buyers. Okay. So if you buy a stock, if you buy options, then theta is going to eat away the premium. So the value is going to decrease, every day, including the weekends. Okay. So even though trading is not happening on the weekends, theta is still eating away at your premium. So that's why we make the decision sometimes to not hold on to trades that we entered as a buyer, to go ahead and take profits before, if it's going to have a negative impact, if time is going to have a negative impact on us. So it helps with our trading decision to understand theta. Now, as a seller, you really don't have to worry about time, because actually time is your friend. So every day that expires, you're going to make money. If the stock price doesn't move at all, you're still going to make money, and you'll make money based off of time alone. So that is theta. The next variable is vega. So vega is the measurement that measures every 1% move in implied volatility, how that impacts the premium of your options. And again, this is really dependent on the strategy that we're going to use. When we get into the strategy selection courses, you'll be able to see how vega impacts those strategies. Okay. So whether you're a buyer or you're a seller, whatever that position is, vega can impact it helpfully or harm your position. And so having insight on these different variables, the Greeks, helps you as a trader to manage risk. You can actually calculate risk before you ever enter into a trade. And that's one of the things that I like about options, because I can actually see what's going on before I even initiate my capital. A lot of the mistakes that we see lots of new traders that have not had any training, what they normally do when they get into the options game is that they will actually go and try to buy calls. This is an easy strategy to put on. It's very, very simple. But they'll go and do a cheap out of the money options. Like they'll go down here and choose, a $16. We've got 16 cents here. So that's $16 options. A $16 options, 345 strike. And they're anticipating that the stock is going to move up. Maybe Apple's dropping a new phone and they say, oh, I'm going to make some money in the options world. I'm only spending $16. And it sounds great. But in reality, it's terrible position because the Greeks actually tells the story. And the Greeks is going to let us know the outcome of this situation before you even get into it. So the Greeks helps you to become a more intelligent trader, okay? Because the thing with this particular strike here, although Apple may move up in that price and it may do as you predicted it for it to do, but you might not make no money. So you can be right and lose money with options. So that's what the Greeks help us to do. It's going to help us to actually get into better positions, choose better strikes when we making our selections here, okay? So what I want to do is actually set up the options chain here real quick. And we're going to go to the layout. And I'm going to explain this further. I want to show you guys. It's better for me to show you guys how all of this works. So what we'll do is I want you to go to this Delta Gamma Theta Vega preset and just click that here. And this is just so you guys can see how these things work. And then I want you to go back in here. I want you to hit customize. And then I want you to scroll down to Theo price, which is the theoretical pricing. And the Greeks are basically, theoretical pricing here. So this is Theo price. So we want to add that in there. Okay. And I just want to make sure all of this is reset to 0 before we begin. So I'm going to take all of these to 0. Oh, I can just hit reset. All right. So we make that at 0. And then what I want us to do is to actually initiate a position. We're going to initiate a long call position. Right here at the 73 strike, let's just let's do the at the money strike right here, and we just right click that, hit buy, hit single, and when we hit that, we want to go to where it says single here on the order entry tool. Right click that, and then go to analyze trade right here, and this is going to actually take us to the analyze tab. So bingo, there we go. Now we're under the analyze tab. And you want to make sure that you're on the risk profile, and then you'll actually get this profit loss grid in front of you with the big screen. And under that, you'll get these price slices, okay? In mine in particular, I only have one price slice here. Let me add some slices so that my screen looks like yours, I guess. Let's try this. And so yours may look similar to this where you have, 3 different strikes. So for the case of what we're doing here, what I want you to do is go ahead and eliminate those, the one at the top and the one at the bottom. And we want to keep the one in the middle. So we're going to the right side of the screen. We're going to click that. And then we're going to hit delete slice. That's going to get rid of that first slice for us. And then we're going to hit delete slice on the bottom one. And now we're stuck right here with the trade that we're actually working on right now. All right. Now, before we get into the nuts and bolts of this, let me actually give you guys a quick real world case scenario so you can understand how the Greeks are actually going to work so that you can fathom this. So just think about the Greeks in the form of real estate, market value of a home, okay? So you think about how much is your house worth. It's going to be dictated based off of different variables in the marketplace. Like there could be improvements that you made to your home or neglect to the home that can take away value of the home. Your neighbor's homes, okay? If your neighbor actually puts a mobile home next to your home, then your house can actually lose value. Now, if your neighbors are actually jealous of you and they want to put a new roof on their house the same way that you put one on yours and they put a swimming pool in the backyard and everybody does this, this is going to have a positive impact on the value of your home based off of your neighbors. So think about that as another variable. Also think about how long it takes for your neighbors to sell their home. If your neighbors' houses are taking 2 to 3 years to get off in the marketplace, well, it's going to be hard for you to get your house off in the marketplace as well. And that could diminish the value of your home. And if, they're able to, liquidate those houses really quick, then basically, the value of your homes could increase. So that's a variable, individual variable. And then crime. Think about crime, how crime impacts the value of your home. If you live in a crime-infested neighborhood, then the value of your homes are going to be very suppressed. But if you live in a low-crime home, as crime, lowers, then the value of your homes will start to appreciate. So they start to go up in value. So if you think about how those individual variables are changing constantly, and also the market value of your home is going to be changing also. And then not to forget, interest rates, okay? The way the interest rates, the mortgage rates, what have you, that's another factor that also adds or take away value of the home itself. So just think about all those different variables. That is what the Greeks are to options, okay? So hopefully that sticks in your head. And so what we're looking at here on our Analyze tab, and this is Apple, which is the underlying stock, what I want to do is actually break down the individual variables and how they impact the premium of our contract, okay? Now, if you guys remember in the previous class, we talked about intrinsic value, we talked about extrinsic value, okay? Time value and price value. So if we take a look at these Greeks, we could take a look at the first two, which is delta and gamma, and these two are the intrinsic value of that equation. And theta and vega is going to be the representation of the extrinsic value. So this is, you know, if you want to break down intrinsic and extrinsic to a molecular level, then you got to come to the Greeks. If you understand the intrinsic and extrinsic values, then you can get away without, you know, having to really dive into the Greeks, not really having to worry too much about them. However, they do add value to you as a trader to make you a smarter trader, help you to manage your trades and things like that. So that's basically what we have here. So the price variables that we have here are going to move here. So I'm going to look at this indicator here, and what I'm going to do is add a price move in the underlying stock, and we're going to see how the Greeks are going to behave towards that. So what I want you to see here is that based off of this dollar value that we have, which is $14 here on this call option, it looks like we will enter this trade at $1.48, 1.48% profit, which is $20. Let me actually increase that a little bit so we can get it close to zero. Yeah, so again, this can help you to actually, you know, in this Analyze tab, help you to choose some, you know, better pricing points, because you can enter into a trade negative and you can enter into a trade positive already with a profit. Yeah, your entering position. So this is the closest to zero I can get it to, about $14.20. We can dial into that more, but, you know, we're crushed on time, so let's get to it. So $14.20, if I enter into this call position at that, then I will enter in at 75 cents. So it's not going to be perfectly clean, but, you know, just understand I'm starting with a 75 cents advantage in this trade. And we want to focus on delta. How does delta impact the options premium itself? So we're going to actually move the underlying stock up by $1. And you see that we have 54.96 is our delta here. Okay, so based off the principle of the Greeks, every $1 move in this stock, then we should gain $54.96. So let's move it up $1. Bingo. As you see, the profit loss over here, we're at $56.31 for our options, which is different from the stock itself. Because the stock moved up $1, we've made $56, okay? So, and let's increase it by another $1, okay? And in fact, let me do this. Let me pull up the calculator for you guys. You got to go to the side tab. You can see right here the little calculator. So let's just go ahead and type in. You don't have to do any math. Trust me, the platform does the math for you, but I just kind of want you to see this. So $56.31, and our delta is at $56.15. So what I'm going to do is plug in $56.15. We're going to add that $56.15. It's not going to be perfect. It's going to be close. So that says $112.46 is how much our premium is going to. That's how much premium we're going to make if this moves up another $1. So let's actually see if that comes in fruition. So let's move up $2. Bingo. So $113 is close enough, right? There's other factors that's in here, but that's what we're looking at as far as price movement. We can see how the delta actually shows how much money we're going to make. Okay, let's take it up another notch. So we got $57.33 is the delta. Let's move that up. 57, add 57.33. That's going to put us around 169. Okay, so let's add that to there. Bingo. So we can go ahead and, you know, anticipate if, you know, Apple, we're anticipating to move up $3. Then we should make $170 basically off of the price movement alone, not even factoring in the other Greeks, but just this one, you know, factor here. And it works the opposite way as well in case stock moves down. So let's say if Apple moves down $1, right? That's $54.96. Okay, so let's move down $1, and we got what, $53.61 that we lost. Okay. And continue to go down by $2, $106. And if Apple drops $3, we can see that we will lose $158 on this position based off of price movement alone. All right. Now, the next Greek is the gamma, which gamma kicks in after the first $1 has been priced in. So after Apple makes its first $1 move, okay, it makes its first $1 move, delta kicks in. Gamma does not kick in on that one. Gamma kicks in on the second one, and gamma basically adds to delta. So you basically just add delta and gamma, and then that's going to actually let us know how much money we're going to make. So then we'll go to the $2 here. Bingo. So the $2, and then you'll see that we made $113. And that's based off of Gamma accelerating Delta, okay? And Gamma gets big as we get close to expiration. And it basically, if we look at this profit loss grid, you'll see the curve on here start to go up like crazy, okay? But that's if we had a higher Gamma. And this can increase based off of like how many contracts we're trading. Like in this case, we're here, we only have one contract. Well, let's just say if I put like 20 on here, now we see that everything, everything goes up higher and Gamma goes higher. And if I increase Gamma even further, just keep on going, you'll see how the curve is going up, and that represents how much profit we're going to make. That profit is going up exponentially. So the bigger the Gammas, the bigger the move of Delta is going to be. So that's the bigger the move of our options premium. And this actually increases as we get closer to expiration. So I just want to show you that illustration that's how they work. And these two together represents price movement alone. It's price move. That's how much our options are going to gain. All right. So for the next Greek we have is theta. Theta is the variable that's going to represent time. Okay. So say if, again, we have the stock moved up $1 and, we made this money off of here and Delta, $56.15, what have you. But theta is going to be the representation of every day that passes. Now, because I entered into this position as a buyer, my theta is going to be negative, letting me know that's how much money I'm going to lose every day that passes by. Okay. And so we go down here to the date tab. I can actually represent that and theoretically look at that. How does that look in the future? And what you do is focus on theta alone, and you'll see how much money we're going to start to lose as every day passes by. So we go to the next day. We go to the next day, and we see theta is starting to get bigger and bigger. Let me just hold it down. And you see theta is getting bigger. That means that's how much money we're going to lose every day that passes by. Okay. All right. And so if you were actually focusing, if you're looking at the options, the profit loss open, let's just actually take this back to 0. If you take a look at let's take it back here. Okay, so let's say we entered into this position here, positive. If we just change the date alone, say the option price don't move, not at all, but theta does. A day goes by. Look at how much money we've lost just from time eating away. That second day, time is going by. So we're going to lose a value of $27 the second day. The third day, we're going to lose $28, $29, $29.79, $30. So every day that goes by, our P&L is, it's exhausting because theta is eating away time. And remember, I told you earlier that theta is going to be based off of, our strategy. Are we entering as a buyer or a seller, right? And so as we see theta is negative for buyers, buying strategies, if we flip this over to the sell strategy, we're going to see that theta turns positive. And as you can see in this position, it says that we're negative right now, right? But let's just add a day. A day goes by. Boom. And then we made profit off of that alone, $27. Let's make another day go by. Now, $27.71 was added, okay? And every day that goes by, this stock doesn't move at all. We make money just off of time. As you can see, we're up $700 now just from time passing. And if the stock doesn't move at all, we're going to make money off of that as a seller. So theta, remember that theta is the friend of sellers, and selling positions are easier to manage because you don't have to worry about time. You can kind of relax because you know that time is working in your favor. But as a buyer, you have to worry about time because every day that's going to eat away the premium of your options. And then the next Greek is going to be Vega. And Vega is actually, we see Vega here in this case of a seller. Negative is telling us that's how much money we're going to lose in this position as a seller. But if we flip that back over to buy, then the Vega is positive for us. And so basically it's going to let us know as volatility increases, we're going to make money based off the volatility alone. And so how we actually find the volatility is you go to under this gear tab, and then you can hit volatility adjustment, and we can just add or take away 1%. So every 1% move, if we take a look at our P&L, we'll see that we just made $27.91. We made just off of volatility increasing. 2% move in volatility. We made money just off of volatility. Let's put 10% here. We made $300 just off of volatility alone. And let's say as a buyer, if the volatility drops on us $2, then we lose $27.91, it tells us. If we lose $3, okay? So these are individual factors when you weigh all of these together as far as the pricing. This is the intrinsic value of the options. And then the theta and the vega is going to be the extrinsic value of the options. And so that's actually going to help us to understand how these variables work for us. And then you got your interest rates right here, actually. And as you can see, if this goes up, we are actually making money. As it goes down, we could be losing money. And right now, the interest rates in real life is, 0%. We take a look at interest rates based off of the 3-month treasury bills. Okay. But that's basically the Greeks, and this is how they work. Okay. So you can actually, simulate basically what can happen to your contracts when, things are happening to the underlying stock. And this basically answer questions that you have. And you say, hey, man, the stock went up, but I didn't make any money. Or you say, hey, the stock went down and I didn't lose any money. So how did I not lose any money? Well, you come to the Greeks over here and you can see what happened. Well, if the volatility went up, maybe price went down, but volatility went up, and that helped you. If you made more money on the volatility side, then it cancels out what you lost on the delta side or on the theta side. So that's basically how they work all together. Now, last thing I want to show you guys here, we're going to go back to the trade tab. And we have the delta, gamma, theta, vega, theo layout here. And we can actually take away, actually, we can just leave that there. So basically what you can do, you can actually also simulate that here under the theo price. And you just have a focus point. So we just focus here at the money. And we just click here. And then we can adjust the stock price. And what you look at is the deltas. Okay. And we can see the price here. We can see how the pricing is here as we move this up. So the theo price is moving up as we move the stock price up. Okay, so just same thing that I was just showing you guys. You can see it here on your layout if you choose this layout. Stock price goes down. You'll see that the value of your options premium is going down. Okay, you can see that here. That's just if the price alone moves. So again, these are just the individual variables that's making up the whole entire pricing model here. And then you can take a look at volatility as well. We can increase volatility. You see how the premium of the theo price is going up. And if we drop it, we can see how it goes down. And if we change the date, we can also see how the theo price is changing. Okay. And it's based off of time passing. So you can see all of that right here on your tab here. Another thing to remember before we conclude here is that delta is the king Greek. If you don't get anything, make sure you understand the delta is the most important one. So that's why on our signature layout here, we keep delta there. And the reason why, let me just take you there, is because delta, let me just go here to this one. Delta represents probability, okay? So when we're trading, we're normally trying to get in and out of trades pretty fast. We're not calculating and crunching numbers because the platform does it for us. But we definitely want to make sure that we pay attention to the deltas, okay? So the deltas has another function which tells us probability, okay? So delta tells us whatever your delta is here is going to give you the probability of your options expiring in the money, okay? And that's important because if you are buying options, you need for that thing to expire in the money. But if you start here at the money, it's going to be closer to 50-50, which is like a coin toss, right? 50-50. As we go further in the money, we have like delta 77. This means that we have a 77 probability with this strike that it's going to expire in the money. Okay, so that's probability. Now, if we go down here, like the newbies, they try to get the cheap ones. This has a, 2% chance that it's going to expire in the money. So you have a very low probability that this trade is going to work out in your favor. As a, uninformed trader, you would definitely make a terrible decision with trying to buy this out of the money, options here. And if you could tell all the out of the money options, okay, these don't have intrinsic value. So they have a lower probability of making you money. So as a buyer, we're buying the long call strategy. We try to stick around delta 70. This 77 pretty much represents theoretically every $1 move that Apple is going to make. We'll make 77 cents on the dollar. So 77 cents on the dollar. If you go further up, you'll see, you get, closer to $1 when you can make $1 on $1, basically. 77 cents is we try to go around this area here. We have a higher probability. versus coming out here out of the money, which is a lower probability. So again, the Greeks is going to help us to navigate, strategize, to mitigate risk. That's basically what it tells us to do here. So I just want to, illustrate that to you guys, and we'll get further into the Greeks as we get into our strategy selection. But that's basically the Greeks overall. If you guys have any questions,